Hello, everybody. Thank you for joining us. You are on Echelon Decodes. We are asking, what is modern monetary theory? And is this something you should really care about? Will modern monetary theory in Sri Lanka have an impact on the economy, on businesses, and on people in general? Economics acquired this fairly recently. This MMT, or as we know, modern monetary theory, entered the economics lexicon fairly recently. Some say it is Keynesian economics, if you are familiar with that, in a modern drab. But we want to ask today's panel, and I'll introduce them very quickly, about what modern monetary theory is, and also about its relevance to Sri Lanka in the context that we are currently in. What are the challenges of trying to do modern monetary theory in Sri Lanka currently, right? And I must say the information we have about what Sri Lanka plans to do around MMT is fairly sparse. There've been some statements, there've been some actions that we could maybe surmise that potentially meaning that policymakers and the monetary authority seem to be taking on some principles of modern monetary theory, but we don't know for sure. There's not been sort of an extensive discussion on this. And let me quickly introduce the panel to you. We two gentlemen that need little introduction, but I will do so. We have W.A. Vijayawardena. Mr. Vijayawardena is always on the media, is very popular. His column in the newspaper, in the Daily FT, is quite a popular one. And he's been a commentator on economic affairs and an academic in the time since he left the central bank, where he was deputy governor of the central bank. Deshal Dimel has had a long career as an economist in research, and Deshal's also worked in the private sector and now works for the think tank Verite, where he is research director. Thank you very much, Deshal. Thank you very much, Mr. Vijayawardena, for joining us. I'll start with asking each of you to make some opening remarks. Maybe in those opening remarks, you can also try to define for us or capture for us what you think is modern monetary theory. Can I start with you, Mr. Vijayawardena?
Yeah, thanks, Shamindra. And in fact, we have learned, and all the central banks in the world, including our own central bank, they follow monetary theory and not the modern monetary theory. In fact, the main features of the monetary theory which they follow is that there is a thing called money. Money is simply a notion in our head. It has no any real existence. And it will help us to exchange goods and services, which are actually real things, which we can consume or we can use as an input for further production. And the money is simply a facilitator in that sense. Therefore, when you use money according to the monetary theory, which the central banks are practicing, if you produce more money than necessary, what would actually happen is the prices of these real goods and services will go up, which we call inflation. And when the inflation sets in an economy, there are lots of other complications that would be brought to the economy by an inflationary situation. For example, the people will start looking only for the present, not for the future, and the investments will come down, interest rates will go up, and exchange rate will start depreciating, and all kinds of savings will fall, and all kinds of things would happen. So therefore, the monetary theory tells central banks to use that particular money, because central banks have the monopoly power in almost all the countries in the world to produce money. And that monopoly power has to be used carefully, and that is the fine lesson which the central banks are practicing. In fact, our own central bank also up to recently had been practicing this, because they were following a new monetary policy platform called the inflexible inflation targeting. So under which they will produce money only to the extent that is necessary by the economy. The modern monetary theory is a breakaway group from the mainstream economics and nothing to do with the monetary theorists. They have drawn their wisdom from the old Keynesian economics, which you correctly mentioned here. In the Keynesian economics, what Keynes proposed in 1936 was that government can print money, use that money to help people to have good buy goods and services. Then there will be an aggregate demand in the economy, and the aggregate demand will cause aggregate supply to increase. When aggregate supply increases, the Keynes argued that there will be economic prosperity, employment, and everything will, and we'll have a jolly good time with the Keynesian economics. What happened was the Keynesian economics was tested when it was tested for open economy, because the Keynes never expected his theory to work in an open economy. It was a failure. Then there were all kinds of breakaway groups, the post-Keynesians, modern Keynesians, and then a new group came which called himself the new Keynesians, and that new group had come up with this modern monetary theory, and they had actually drawn their wisdom from not actually, even though it is called modern, it is not modern because it's about, say, if we examine the history, it goes back to about, say, 300 years. Because when the John Law, one of the Scottish economists, who was serving the Louis XIV of the French government, he in fact presented the foundation of the modern monetary theory in a book called Money and Trade Considered. And what he suggested was the king can print money, provide that money to the people, then there will be trade, improvement in trade. Trade will bring in prosperity, and France can get out of all kinds of economic problems by printing more money. But it actually misfired, and in fact, for the first time in the world, the private central bank which John Law ran with this particular concept became bankrupt, and finally the French government had to accept that that particular wisdom has not worked. But today, of course, there are several breakaway economists in the West who have come up with this theory, and one was this Warren Mosler of University of Kansas, and then Ray, and then most recently the Stephanie Kelton, who had been working as the economic advisor to Bernie Sanders, and one of the senators in the US government. And she had been one of the advocates of this modern monetary theory, and she wrote a book called Deficit Myth, because according to her, anybody who argues that the government deficit, budget deficit is evil, she said that's a myth. And therefore, she has advocated that the governments can work by printing money, and by printing money, governments can solve all kinds of problems that we are facing, starting from, say, environment to poverty alleviation to income distribution, all the economic issues which we are faced today. Stephanie has argued in her book could be solved by printing more money. So that's the crux of it. But unfortunately, most of these, the policymakers and the politicians in the developing world, whose currencies are not reserve currencies, have adopted this modern monetary theory uncritically because it is sweet music to them. Because instead of working hard to raise revenue and spend that money through the budget, it is very easy for them to get the central bank to print money and spend that money. So that is why it has become very popular in the present top management in the central bank, including the monetary board. So they have been supported by the Ministry of Finance because it is to their advantage that if the central bank prints more money, and also the presidential secretariat is also actively supporting that. So that is where we stand today, Shamit.
Okay, so Deshav, that's quite the introduction to MMT. Is there anything you want to add? And also, eventually in this conversation, we have to look at maybe the potential of applying MMT or some principle of in the short term. And I'm playing the devil's advocate here. I'm playing the card that okay, is there potential to use deficit spending in the current situation Sri Lanka is? But I'll leave you to make opening remarks.
Thanks, Shamindra, and thanks for inviting me to speak today. So Mr. Vijayardhan gave a very kind of broad view of what MMT is, let me just take a little bit about the more recent inspirations for MMT that we've seen globally. So I think a lot of the popularity of MMT kicked off post 2008 in the immediate aftermath of the global economic recession, where we saw central banks across the world printed large amounts of money, significant quantitative easing across the Federal Reserve, Bank of Japan, ECB, everything. But that did not really result in an increase in inflation as typical monetary theory would have postulated. And also, so MMT proponents believe that this link between low interest rates and investment is also broken, right? So now, typically in normal economic theory, when interest rates come down, that triggers demand for investment, and then that supports growth in aggregate demand. Whereas the experience that we have seen globally post the GEC has been that even though global interest rates are at historical lows, we haven't seen a concomitant increase in investment in countries like the US, Europe, Japan, and so on. So the belief of the MMT theorists is that, look, in the situation where the monetary policy is not being able to generate a desirable or a required level of economic stimulus through the investment channel, then it is incumbent upon the fiscal authorities to make use of the low interest rates and basically run a high budget deficit in the time of a economic downturn. So the theory is that you have economic downturn, you run a high budget deficit, government will spend that money without worrying too much about the source of financing. And the reason there is that the central bank can print money and provide it to the treasury without effectively crowding out the rest of the economy. So you can basically run a high budget deficit without driving up interest rates, which is what normally then would crowd out private investment. So the idea then is that you keep running this equation until you reach full employment or until you reach the objectives of government. And it's not to say that MMT theorists are completely averse or they deny inflation. They agree that inflation could trigger at some point. And that trigger point will vary between different countries. What they say is that once you reach that level of level of economic activity or level of demand that generates inflation, at that point you raise taxes and pull that excess cash out of the system, and thereby you bring back aggregate demand to a level which is then not going to generate inflation in too much in a substantial way. And in effect, what they're doing is they're using a fiscal tool to achieve an objective, which is inflation control, that we are used to achieving through a monetary tool. So normally when inflation increases, we raise interest rates and curb inflation that way. So the modern monetary theorists turn that on its head, and they say that, look, monetary policy needs to be subordinate to fiscal policy, and that you can still control, you can achieve your objectives with regard to inflation by pulling out, by raising taxation when required. And at the same time, you can achieve your objectives with regard to reducing unemployment, with regard to your environmental goals, with regard to social protection, and so on as well. So it brings all these equations together. But I think what is important to understand is that this theory can be sustained under certain unique circumstances, and that those circumstances have held in the short term in a few countries, like in the US, Japan, in some parts of Europe, and so on. But it doesn't mean that this can be then applied to all countries in an equal manner, because of course starting conditions are different and other circumstances are different as well. So we can go into those as we progress along today's discussion.
Okay, so a quick note to everybody on the call. We are happy to take your questions on Zoom. If you're on the Zoom call, you can post your questions there. We can all see the questions, I think, then also. If you are on Facebook, on the Echelon channel, or on Economy Next, please put your questions in as a comment. I will try to harness them for this call, but Zoom is much easier for me to get at for questions. So, but do post your questions. We'll get to them very, very quickly, right? Mr. Vijayvardhan, if I can come to you, and I'm coming to you from where Deshal left off, right? I mean, Sri Lanka is in a little bit of a bind. Sure, it's got a very difficult situation with the foreign debt that it's got to settle, etc. But it has also got this challenge with the pandemic, like most countries. But Sri Lanka's situation is that it has got both an economic difficulty and pandemic has worsened that issue. Deshal suggested that potentially modern monetary theory, at least in some places, can be deployed in a limited way in these circumstances. What do you think about deficit spending in the current scenario, in the current economic situation that we are in? Is some level of deficit spending worth the risks of inflation that Sri Lanka should take?
Well, Shamindra, throughout the post-independence history, Sri Lanka had a budget deficit situation because, except in 1954 and 55, where we had a small surplus in the budget, all other years have been characterized by a deficit situation. So, in fact, in a limited way, we had followed the modern monetary theory. We had got the Central Bank of Sri Lanka to print money, give that money to the government. Government has spent them, and finally, the result had been, the Sri Lanka's inflation rate had not been, low. It had been very high. For example, if you go by this old Colombo Consumers Price Index, which the base year is 1952, and it was abandoned in 2007, and they had gone for a new Colombo Consumers Price Index. But if we plug the data into the old Colombo Consumers Price Index, in 1952, the price level was 100, but if you take today, the end of December, the price level is 14,000. So which means that, a rupee in 1950 is worth less than 1 cent today. So that means it has actually eaten up the real income and the real prosperity of the people, because the people's income has not gone up by that percentage. So what it means is that even though Sri Lanka had this limited amount of modern monetary theory, it had not been a successful factor in Sri Lanka. To answer your question about the current situation, yes, in a limited way, the central bank can print money and make available that money to the government, because the government had already messed up its budget by offering a very attractive tax concessions to people immediately after it came to power, by cutting down the income tax and cutting down the VAT, which had eaten up about, say, 500 billion rupees out of the government revenue in the year 2020 alone. So 2021 also will be repeating the same thing. So as a result, the government's budget deficit has gone up to a level of, say, 10% of GDP from around, say, 6%, and we don't have enough income. At the same time, the country has been hit by this pandemic, which requires the government to spend more money. So there is no any other solution for the government, because the government has already messed it up in the fiscal sector. So that is why it is turning very hard to the central bank and the banking sector to borrow money. For example, latest data released by the central bank about the money supply, during the first 11 months of the year, the government had borrowed from central bank as well as from commercial banks a net amount of some 2.2 trillion Sri Lanka rupees, which is a record amount. At the same time, the government corporations have borrowed about 600 billion, which means that the total wider public sector has borrowed about 2.8 trillion Sri Lanka rupees from the banking sector during the first 11 months. And the demand for money is, has not stopped there. Demand for central bank and the banking sector credit is rising, because there are two other factors. Because the central bank had been following this low interest rate policy, it has pushed down the interest rates to about, say, 4% recently to stimulate the economy. But it has, had other implications also for the economy, because the rupee is now under pressure for depreciation, despite the fact that some of the imports have been controlled by the government, because the import control has been basically for about, say, 20% of the total import bill. Still, it's a good amount, but still, despite the fact that the remittances had come to Sri Lanka at the same rate as before, and we are in a situation where the rupee is under pressure for depreciation. So this low interest rate policy in Sri Lanka has actually backfired, because two reasons. One reason, number, is that the international community has noted that Sri Lanka is following this MMT. And as a result, the international sovereign bonds issued by Sri Lanka government, which are being traded in the secondary market, they are being traded today at a deep discount. For example, the bond to mature in 2030 is being traded at around, say, $60 with a discount of, say, say 40 US dollars per $100 bond. And at the same time, the interest yield has gone up to about, say, 15%. So, which means the Sri Lanka cannot now raise money from outside the country unless it is prepared to offer a very high yield to the prospective investors. It was demonstrated, Samindra, in the recent Sri Lanka development bond issue by the government of Sri Lanka. Now, these Sri Lanka development bonds were, the government started issuing them in 1998 in order to attract the locally held foreign exchange by commercial banks in the form of these non-resident foreign currency account balances. And objective was to borrow it at a, say, rate of, say, 4% per annum. And historically, we had been borrowing at that rate. But when the recent offer for 200 million US dollars was made for Sri Lanka development bonds, there were only 43 million US dollars that was taken by the government, and because the balance was at high interest rates. Even what has been taken at 43 million US dollars, it has been taken by at around, say, 7% rate of interest. So that means interest rates have already gone up, even the local domestic foreign exchange market, from, say, 4% to 7%. So why this modern monetary theory does not work in certain areas, as Deshal said, was if your currency is a reserve currency, which means the rest of the world will use it for transactions, for keeping their wealth, and also for the purpose of facilitating exchange. If your currency is a reserve currency, you can print any amount of currency, because that currency does not cause an increase in the aggregate demand in the economy in subsequent rounds. Because, for example, if the US government prints $1 and hands it over to the US citizens, they can demand, the goods and services for $1. But immediately after that, since dollar is being used as a reserve currency by the rest of the people in the world, and the money goes out of the United States. For example, the US government had, during the first 12 months of this year alone, in order to address this COVID-19 pandemic, they have printed about, say, 3 trillion US dollars. But out of that, 40% is circulated outside. A good example, Samindri, that, for example, suppose a Sri Lankan fellow stitches a shirt and sells that shirt for $1 to an American fellow. An American fellow will immediately get the benefit of using that shirt, which is a real product. And our fellow will get a little piece of paper which says $1. And instead of taking that dollar back to USA, we will use that dollar to buy, say, medicine from, say, India. India will use it to buy, say, some other good from Indonesia. So it is eternally circulating outside. So as a result, it doesn't cause inflation in USA. That's why US inflation is less than 1% over the past years. But it is not the case with Sri Lanka. We cannot print, our currency is not a reserve currency. So we cannot print money and borrow abroad. Our debt issue we cannot settle by printing Sri Lanka rupees, because Sri Lanka rupee has to be converted to US dollars. So when a country's currency is not a reserve currency, the MMT or Keynesian economics does not work. I mean, this warning was given to us by none other than John Exter in the very first press interview he had after the establishment of the Central Bank of Sri Lanka, and also in the extra report also he has said, don't use Keynesian economics or Keynesian stimulus packages uncritically in an open economy. So that was the warning given to us. So we are now in that particular soup, Samit.
Okay, so if I ask you, if you were a policymaker and you were keen to extricate us from this short-term pain, while also maintaining some semblance of economic stability for the future, is it not good to run a slightly higher deficit, risking inflation? Because currently, although we don't have good data on this, it looks like lots of people have lost their jobs, have lost their livelihoods, and it may take, if not for stimulus, it may take people or ordinary families many more months to get back to work and re-establish their livelihoods.
Well, you have a point, Samendra. Definitely to go through the present economic, economic recession that we are faced with due to the pandemic, there is definitely a necessity for the government to run a higher deficit. There's no question about it. Again, as Deshal has also mentioned here, we have to use this monetary policy or money printing capacity of the central bank with limited application. We cannot, solely depend on the central bank as the main source of revenue for the government, which is wrong today. But of course, the deficit has to be funded to some extent by the government, by the central bank. But at the same time, if we use it with, some limitations, we may be able to use monetary policy to help the government to overcome that particular problem. But to overcome a problem like this, where the economy is suffering from a massive unemployment, income loss, and reduction in all kinds of other welfare levels and so forth, the government alone cannot rescue the economy. It is the whole economy that all the people like us will have to make a supreme sacrifice. Now, what is missing in Sri Lanka is none of the policymakers at the top are asking people to make this sacrifice. And one good example is this: the investments that come from India into this east terminal of the Colombo port. I mean, people say that, we can do it. Give us 500 million US dollars and we will use that money and we'll make it profitable and we'll reap it. But where do you get this 500 million US dollars? That is where we don't have it. So that is why it has to come from an outside. So that is, similar to a situation where, private limited liability company with family ownership, they don't want to get equity investment from outside because they think it dilutes their ownership and it reduces their power. But they don't mind borrowing from outside. So the people who are canvassing for this, the agitating against the Indian investments in the Colombo East Terminal of Colombo Port, they are just like a family-owned private limited liability company. They want to borrow and build up the port, but they hate, getting equity investment because it dilutes the Sri Lanka's sovereignty and so forth. So that is where we are here. Samit.
Deshal, do you agree that, in this climate, the central bank cannot be really asserting completely its independence? It has to maybe work closely with the fiscal authority and potentially help the government out with the large deficit it now has. How do you strike, if you were, advising the monetary authorities, how do you strike a balance in this climate of a central bank that can fundamentally is an independent institution, but the country is facing an unprecedented economic challenge?
Yeah, so I think a lot of it comes down to timing, right? So I don't think anybody contends the fact that during an economic downturn that there's a need for stimulus, be it fiscal or monetary. The key is to have an exit strategy at the correct time. So in Sri Lanka, what we saw in 2020, it made perfect sense in my reading to have some level of deficit financing by the central bank, because you didn't see that really feeding into excess demand, right? Because we saw at that time private sector credit demand was very low; it was negative between the months of say May and August, and during that, so with private sector credit demand being so low, there was space for the government to have a greater degree of credit demand in the market without causing overheating of the economy. But that at some point that is going to come to an end, right? That when the economy starts recovering, which we all hope it will in the coming months, at that point you need to find an exit strategy from this system of deficit financing that we have. Now, I think that is really where we really haven't seen that exit strategy being spelled out in a clear way thus far, right? So we have been running a high level of budget deficit. And really the exit strategy, I think a critical element of that exit strategy will be identifying how we shrink that deficit in the medium term. So now the government has said that it intends to keep the current tax policy in place for the next 5 years. So whether we can have a meaningful addressal of the deficit within that 5-year period whilst maintaining our tax policies as they are, that to me is not very clear. So really it comes down, and of course starting points are important as well, right? So many other countries, when we talk about stimulus, they're starting from a point of a budget deficit of say 2 or 3%, and they can push that up to say 6 or 7% without causing too much stress. In Sri Lanka, we are talking about a budget deficit that's already at or just below double-digit levels. So keeping that on for a long period of time or extending that in the to beyond the short term is a very different equation to going from 3 to 5 or 3 to 7, right? And the same with monetary policy. So again, countries that are looking at MMT are the starting point where your real interest rates are either negative or at zero. Whereas in Sri Lanka, we have positive real interest rates. So there is still space for the relationship between investment and interest rates to work in Sri Lanka. And we don't really have any evidence to suggest that that relationship is broken. So the applicability of MMT to Sri Lanka's particular circumstances, I don't think is the same as the applicability to, say, a country like the US. I think that is really where the crux of the matter is. A, that exit strategy and the conditions in which MMT can work and can be sustained, and whether that works in Sri Lanka or not.
Mr. Vijayavardhan, how does one go about crafting an exit strategy now? Deshal has highlighted the dichotomy that now faces everybody when the government has already said that for 5 years we will not change this current tax regime. So, if unless it changes its mind, there is potentially an imbalance here. How does one start from here? Is there any other way besides taxes? Must not the government always pay for its expenditure through taxes ultimately?
Well, the modern monetary theories say that the government does not need to tax people in order to spend because they can print money and spend. But as Deshal had very correctly pointed out, Shamindra, they also argue that once the economy has grown and your GDP has risen to a high level, you may be able to tax it away from the people. Whatever the money created and the stimulus given through money printing can be immediately neutralized by taxing people and taken that money out. And that is the exit point of which they shall have been talking about. For that purpose, Shamindra, the GDP and the tax elasticity should be very high. In other words, when GDP goes up by 1 rupee, the tax elasticity also should be, at a very constant rate. It should be at a very high rate. But in Sri Lanka's case, that is not the case. Sri Lanka's case is that when the GDP goes up, the tax revenue has fallen. Because in 1980s, we had the tax to GDP ratio about 20%, but today it is about 12%. But during that period, the money GDP has increased. What it means is the tax elasticity of income is negative in Sri Lanka and is very low in Sri Lanka. And as a result, the exit time which Desal had been talking about and which you also now raising here, and which is one of the fundamental arguments by modern monetary theories, cannot happen in Sri Lanka. In this case, Shamindra, we have a way to go, because you may remember during the times of the Sinhala kings, people didn't have money to pay taxes, but they paid taxes by way of the commodities they have produced, the agricultural commodities, and their labor. They had the fine system called Rajakarikrame, compulsory royal service. In the compulsory royal service, Shamindra, people like you are able-bodied people, not me. I am now 70 years old. You have to work for the king for 6 months without getting any payment, which means you are paying an income tax of 50% to the king. So same thing can happen now. We have 1.4 million, say the public servants in Sri Lanka. As you know, Dr. Jasudha had demanded some time back, which is I think a very good request, forego 1 month's salary. So we can get the government servants, including the president, the prime minister, ministers, MPs, and all those people who are depending on the government budget. Okay, like private sector companies which did during the pandemic, forego 6 months salary, work for the country, work for the nation. If you are really a patriot, you love your country, you want to bring that country up, work for 6 months free of charge. The balance 6 months you can work for money. What it means, Samindri, that we have to cut down our consumption drastically. If you have having 3 meals a day, probably we have to settle for 2 meals. We forego 1 meal. So this is the type of sacrifice that we have to make if we want to, bring the economy back to the normal level.
Deshal, short of the Rajakarya system, do you have any other ideas currently about what an exit strategy may look like? And thank you, Mr. Vijayavardhan, for being so forthright about it.
No, so I do think that. So I mean, as I said, the addressing the fiscal deficit is really the key here, right? So again, it doesn't mean that we go from where we are today to a deficit of 2% overnight. I mean, that's just not. That's going to kill the economic recovery that we have. But I think what is important is that we spell out a path from where we move from a deficit of where we are 9% today to say 5% in 5 years, and then bring it down further from there going forward in the future. And there are plenty of avenues to do that. I mean, for instance, you have seen measures that have raised thresholds for PAYE, for withholding taxes. All of those can be gradually brought back down to previous levels, because that's really how you can broaden your tax base. And there are a number of other even non-tax revenue measures that can be implemented without hurting growth. So, for example, if you look at telecom spectrum or other forms of spectrum, if those are auctioned properly, you can get a very good form of non-tax revenue to the government. So there are a number of measures that can be looked at, but fundamentally what we have to do is to address the budget deficit in the medium term. Now, MMT basically says that don't worry about the budget deficit. You can have a budget deficit as high as you want, because the central bank can print money and finance that without a problem. But what both Mr. Vijayavardhan and I was trying to argue is that, look, it just doesn't really work in a country like Sri Lanka, where we have 50% of our debt denominated in foreign currencies, and therefore we cannot use the monetization path purely in terms of addressing our debt problem.
There's a couple of questions about this, and that is the high market liquidity currently in the market, and what just to sort of give some background about what's been happening when bills come for or bills or bonds come in for maturities. The central bank prints money and issues basically 1-year bills, more or less, which has led to a large holding of bills in the central bank currently. Is this something that investors or those in the private sector should keep an eye on as a critical indicator of economic health in the future? Because the central bank's balance sheet has exponentially grown. Mr. Vijayavardhan, is this an important thing to be watching?
Central bank balance sheet today is out of shape, but of course with the additional investment the central bank has made in treasury bills at 4.5% per annum today, the central bank is going to make a thumping amount of profits at the end of the year, Shamit. And then the government is also the beneficiary, because the entirety of the profit. Now in 2019, the bank's profits were some 25 billion Sri Lanka rupees, and out of that 24 billion was transferred to the treasury. So if they make, huge amount of profits in 2020, again the chances are that the government will get the entirety of that profits transferred to the treasury, so that government can spend. So what it means is the government is printing money. The yields on printing money is also appropriated by the government. So it's a very, very lucrative business for the government. Whereas the central bank's case, of course, the results would be that central bank will have to have a proper capital adequacy, and without a proper capital adequacy, central bank will also can become bankrupt like any other commercial bank. It has happened to many central banks in the world when the capital became negative. So, so we are in a situation where we are not in a position to balance this properly. But as Deshal has said, the exit level is a very important thing, because I agree with him that, and with you that given the current scenario, where we have a massive amount of unemployment and people are, having economic hardships, there should be some kind of a stimulus. But that stimulus has to come from our real efforts, not from the monetary efforts. That is what I'm meaning. Because the money, many people think that money can do many things, but no. Money is simply, as I mentioned at the beginning, money is simply a notion in our head. It has no real existence. And if what happens, the real existence comes from the basket of goods and services that which we can buy from that money. If that basket of goods and services is shrinking, now again you are asking me about the sacrifice. The sacrifice is, automatically being made by poor people when the inflation sets in the country. Why I am telling you is that the inflation tax works adversely against the poor people, not the high income people, because the high income people are in a position to make a change in their asset structure, moving from financial assets to real assets like the buildings, real estates, and so forth. But the poor people are unable to do that. So as a result, the poor people will have to suffer from the inflation tax squarely. So the inflation tax is a way for a government to tax the low income people and run the government. So that is what has actually happened in Sri Lanka in the past. So that is why the plantation sector is asking for this 1,000 rupees salary increase, and all other workers are agitating for increase, because the inflation in the past, as I told you, the inflation level at 100 in 1952, if you take today, it is 15,000. So the real income has fallen. So because of that reason, people's real consumption has fallen. So as a result, the, 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 the modern monetary theory, when we follow it and when we print money and when the inflation starts setting in the economy, it is the poor people who are transferring. It's right, same as the Rajakari Krame that we had during the king's time. Rajakari Krame was an explicit thing, but here the poor people are paying implicitly without knowing that they are paying a tax to the government.
While inflation is a terrible thing, and not so long ago, about 8 or 10 years ago, Sri Lanka did experience a very high rate of inflation when that was pretty much the talking point of everybody. But I mean, again, let me sort of play the devil's advocate. Is that also inflates away the debt? The debt is a financial asset. The ultimate real value of that debt is inflated away. I'm not suggesting this is a grand strategy, but can you explain what happens here and what is the likely implication in Sri Lanka?
Well, presently we are having a terrible macroeconomic imbalance in Sri Lanka. Our growth rate is falling, and in 2020 it is negative. Even though the government is hopeful that it will become positive in 2021, many of the analysts feel that the low economic growth or negative economic growth will continue till about 2024. The public debt has become a huge issue. Payment of interest on public debt has become an issue, and the government doesn't get enough revenue to pay public debt. And at the same time, the external sector imbalance has been now picking up, and even though there had been curtailment of imports, the trade deficit is only marginally down, and we don't get additional funding via borrowing, so foreign direct investment to Sri Lanka in the current period. And we cannot go out and borrow money from outside either. So as a result, there is a chronic shortage of foreign exchange. Now, good example is that if you take because central bank had very carefully and smartly, it has not published the end of December foreign reserve position in its weekly indicators, which is a must. I mean, in terms of the agreement with the International Monetary Fund under the special data dissemination standards, it has to give the latest data on the reserve position, but it has not published it. It has simply published only end of November data, which gives us 5.5 billion US dollars as our reserve. Out of that 5.5 billion US dollars, there is of course 340 about 400 billion dollars worth of gold stock, which we cannot use immediately unless we sell the gold in the market. And so the liquid foreign exchange available to government is only 5.1 billion, but the debt commitments arising from the borrowings of both the central government and the private sector during the next 12-month period is about 5.7 billion US dollars. On top of that, we have the short-term liabilities about 1.4 billion, which comes to about another, say, 6.2 billion. So now look at where we are. And we are planning to get this soft facility from India and China, which would bring about another 2.5 billion US dollars, but it's a peanut. It's a peanut. So on top of that, if you have to, lend the Port Authority people so 500 million to build up the East Terminal, we don't have enough foreign exchange here. So our position today is that we don't have enough foreign exchange, and it has been, very correctly read by the rating agencies. And also recent country update by Citibank also had, Citibank has, gone even further analysis. It had taken out all the short-term liabilities which the Sri Lanka is facing out of the total foreign reserve that we are having, and they have come up with a stock about the 2.5 billion US dollars, which is less than 1 month's imports. So this is where, that is why now some people say that, we cannot cut the consumption without affecting the economic growth. But here, naturally, we'll be forced to do that because we don't have money to buy foreign goods.
And that is indeed a question that we have, Mr. Vijayawardhan, and also to Deshal. If we reduce consumption at this point when the economy is so fragile, we may scuttle the potential for any recovery.
No, I think I will answer that, Samindra, because the what we mean by consumption, demand for goods is not only the local consumption, the demand by foreigners also. It comes from the consumption plus export. So we cut down the local consumption and make available those goods and services for consumption by other people in the rest of the world. So that is what we are doing. So therefore, there's no decline in the demand for Sri Lanka's goods and services. So what has happened here is today our goods and services exports have become stagnant over the last 10-year time period. So we will have to now curtail our local consumption and make available those goods and services for use by other people and earn valuable foreign exchange. Now, this is exactly the strategy adopted by Japan after the Second World War. They cut down their consumption. I mean, the Japanese consumption level was only 50% of GDP immediately after the war. The balance 50% was exported. And by exporting that, they got foreign exchange for investment, for research, for further expansion of the businesses. So this is the strategy which the government of Sri Lanka should follow. The government of Sri Lanka, instead of promoting domestic consumption, it has to shrink the domestic consumption and make available whatever that has been saved for use by other people. But for that purpose, we need to have a very comprehensive policy for promotion of the export of goods and services. That is where we are lacking today.
In fairness, it may not be something that we can, Deshal, you can also weigh in. This I don't know, Mr. Vijayawardhan, whether we can do this very quickly, right? Because the pain is immediate.
No, we can't do it. We can't do it because I will tell you now, Vietnam came up with a new economic policy roadmap in year 2019, which would enable Vietnam to convert its economy to fourth industrial revolution in year 2030. It's a 10-year roadmap. So we have already lost, many years in Sri Lanka for not planning forward. Now, if you start it today, probably with new technology and new direct investment that we are going to get, probably we may be able to reach our goal by year 2030.
Deshal, would you like to weigh in on curtailing consumption at this point in the cycle, at this point for Sri Lanka?
Yeah, so the problems or the imbalances start to occur when you have excess demand or excess consumption, right? So that's when your demand is growing at a faster rate than your supply. And when you're in a downturn, that's not going to materialize for a while. It starts to materialize only once the economy is recovering. Now, if you look at Sri Lanka's history over let's look at the last 10 years, that the manifestation of excess demand or demand moving faster than supply typically hasn't been so much through inflation. It has really first hit on the balance of payments, right? So that is really what we have seen. So if you look back at say 2011-12, 2015-16, both periods which were preceded by fairly low interest rates, again in that 6-7% range, both of those were immediately followed by balance of payments, basically a sharp increase in the current account deficit, and a balance of payments crisis immediately after that, right? So that is really where that excess demand has manifested in Sri Lanka. So in 2020 we certainly weren't there. We didn't have a sense of excess demand, and that is why we were able to run this model of having effectively elements of modern monetary theory without having a significant impact on the currency and without having a significant impact on inflation as well. Now, the challenges are going to come once we start to see the economy recovering. Now, the BOP issue is really, it manifests because most of Sri Lanka's imports are really are part of the production process. So only 20% of Sri Lanka's imports are consumption imports. 80% of Sri Lanka's imports are either intermediate goods or capital goods. So whenever we have investment, whenever we have economic activity, demand for imports starts to come in. So as the economy recovers, you're going to see this demand for imports increasing, and that's going to put pressure on the BOP. So before inflation starts to bite, it's really this BOP issue that's going to start to manifest. Now, we've seen since the second week of December, early January, we started to see pressure on the currency. So those initial signs are there. So it's at that point that you need to slowly start making interventions to try to address this issue. Now, again, modern monetary theorists or elements of modern monetary theory would suggest alternative ways of doing it. So traditional economics would suggest that this is when you start to raise interest rates in order to start to put brakes on aggregate demand. Modern monetary theorists will probably say, actually, you could probably achieve this by having directed lending. So you tell the banks, hey, you guys don't lend to import-intensive sectors, lend only to the agricultural sector and sectors that don't require imports. So that kind of tool you could also, you'd like to see manifesting in Sri Lanka as well. So really, that the way that consumption is managed can be done in different ways. I'm not going to say what is right and what is wrong, but what we can see is that this kind of policy or this kind of interventionist policy measures are likely to materialize in Sri Lanka going forward. I mean, one way that this is a very tough one to achieve, but one way that modern monetary theory can be sustained is so we know that the government is going to spend money in order to stimulate the economy. If government spending is focused on areas that increase supply capacity, such that the supply capacity of the economy grows at a faster rate than the demand side of the economy, then again, you can prevent overheating. But that is a very tough one to achieve, right? Because you know that there's huge time lag between what you spend and what you invest, and that translating into supply capacity. So theoretically, that is something that government can aspire to. So in terms of attempting to run MMT, that's the kind of spending measure that can really have some chance of coming close towards working. I'm not going to say that it works or not, but that is the kind of salvageable measure that you could run.
Some analysts point out that Sri Lanka's economy has a lot of excess capacity. Simply put, there are lots of idle factories, or you can run double shifts in factories when they are currently running one. Is that true? What is your take on this?
So, I mean, there's certainly unemployment in the economy that has manifested, particularly during the coronavirus. But I think really the problem that even with supply capacity shortfalls, any kind of investment increase, any kind of manufacturing increase or supply increase is tagged to imports, right? That story that I said about 80% being intermediate in capital goods. So that is really where it becomes quite different to Sri Lanka than to say other countries. Whereas in a lot of other countries, you could probably go from a level of low supply to reaching full employment without triggering significant inflation or without triggering too much pressure on the BOP. But in Sri Lanka, we see that kind of nexus between the BOP and economic activity being very tight. So I think that is really where that kind of balancing act becomes quite tough for us.
Mr. Vijayavardhan, do you agree that we'll probably see a BOP crisis before we see much inflation in Sri Lanka?
Well, we are already in the BOP crisis, and we don't have to, wait anymore, Shamindra. We are already in the BOP crisis because we cannot repay the debt that we have borrowed. Either we have to default or we have to go for rescheduling. And the second one is that the currency is under tremendous pressure for, depreciation now. I mean, central bank has been holding on to the current level of exchange rate by, they have a system called this arm twisting system. You twist the arm of the dealers so that the dealers can't work, independently. But no one can, do it permanently. And if at one stage the dealers will, strike back. When you hold some fellow with the twisted arm, he will yield to you temporarily, but eventually that fellow will rise against you, and as a result, you will not be able to. We had this experience in 2000, in 1998, in 2001, in 2009, 2013. The arm twisting tactic is a very short-term one, and it doesn't work, Shamindra. And eventually what happened was we had to allow a massive depreciation of the currency in all these cases. So it doesn't work.
Right. Not that either of you are forecasters or make a living by doing that, but if I asked you, based on your observation of the economy, where do you think the rupee will land in about a year, end of this year? What do you think that is?
Well, of course, if I know that answer, Shamindra, I'll be a billionaire tomorrow morning.
But we know that it's under pressure, but what level of pressure?
Well, the rupee will fall. I mean, definitely, I don't want to give an indicator value, but it will definitely fall. And as a result, I mean, there must be some kind of an adjustment which has to be made, and that adjustment should come. If it comes sooner, it is better for Sri Lanka rather than later.
Inflation will possibly follow and not lead this thing, right? As if if we're going by what Deshal is suggesting. Can I ask you, Mr. Vijayawardhan? Okay, the rupee is something that's tradable. You can actually, it's a financial asset. You can bet on it. What do you think about inflation? Where will we land at the end of the year?
Inflation will be double digit before the middle of this 2021. It will be double digit because right now the central bank is very happy. I mean, you'd have seen an article written by one of my former colleagues in the central bank, Aladas Bandarnaike, in the Daily FT recently. She had said it's like, the ostrich type of, mentality, having, you are hiding your head in the sand so that you think that others don't see you. So what is happening is that you have controlled prices and you calculate your inflation rate by taking those prices into account, and your inflation index doesn't go up. So you are very happy. You are saying, okay, our inflation is 6%. But I don't think central bank will have to do that, because that is why Shamindra, Mr. S. Javadana, with his wisdom, he introduced as the goal of the central bank, objective of central bank, economic and price stability. What he meant was that you can attain this kind of, technical price stability by controlling prices, so intervening in the market. But what is needed by the central bank is to have an economic stability. That means the macroeconomic picture must, be balanced everywhere. The budget and the balance of payments and the domestic credit market, they should balance. If there is an excess demand in any side, Mr. S. Javadana says that the bank cannot be happy about the monetary policy and the monetary conditions, and it has to take monetary policy measures to overcome that. Now, unfortunately, this economic and price stability has been misinterpreted by the current management in the central bank to mean that what it means by economic stability is that they're promoting the economy, which is wrong.
High growth, basically, great growth.
Could I comment, Shamindra?
Yes, please.
So just when you're talking about inflation, I think it's also useful to take a broad view of what inflation is, right? When we typically talk about inflation, we talk about the CCPI and inflation in goods and services. But really, I think again the quicker trigger, I said, along with the BOP, the quicker trigger is asset price inflation. So again, typically when you see this level of liquidity that's being pumped into the market, the first place where a lot of that cash is going to go into is into assets that are seen often as hedges against inflation. So it'll start going into land. It's already, you're seeing it in equity markets. It'll go into gold wherever possible. And this is again not just a Sri Lankan phenomenon. You're seeing this in many countries now, which have been basically in response to the coronavirus pandemic, seen large fiscal deficits and monetary policy being accommodative. You're seeing these significant increases in asset prices across the world. Even the Bitcoin, the fact that asset has gone up to such a high level, again, is reflective of what you're seeing globally with regard to this level of excess liquidity that's being created. So when we're looking at inflation, I think that broader perspective of inflation is useful to take cognizance of.
Can I also ask you at the same time, do you have a forecast that you can make around inflation, if not the exchange rate?
So I think the central bank will be sensitive to inflation going into double-digit levels. So I think there will be a lot more tolerant of inflation than the previous central bank. So previously, central bank had looked at a target of about 4 to 6%, and I think the language from the policy statements that we are seeing is that they will like to tolerate inflation above 4 to 6%, but would want to keep it below 10%. So Mr. Vijayardhan has said that he expects to hit double digits in June. I don't know if it'll get there that fast, but I do think the central bank will start to get jittery if it is showing signs of going into double-digit levels. But it will be tolerant of higher inflation that we have seen in the past.
We did a similar webinar several weeks ago with a bunch of people who were from the capital market, and there was tremendous optimism, not merely because financial asset prices were rising, but tremendous optimism that the government may be able to navigate away from this crisis because Sri Lanka's friends, say China, India, may step up. And I think we are not merely referring to the $2.5 billion in swaps that are about to be arranged with China and India, but we may need something bigger, I think. How practical an assumption is it for those even coming from the capital markets to have that things will work out that way?
Well, Samendra, beggars are not choosers. We are not at liberty to choose from where we borrow, from where we get the assistance. And the two countries which come to my mind in this case is both India and China. They have interest in Sri Lanka, and they might provide economic facilities to Sri Lanka in order to overcome this particular problem. But Sri Lanka will have to play the game very carefully and smartly without offending either party, but by forcing both parties to confront each other and provide funding to Sri Lanka. And in that case, of course, the capital market people are correct when they assume that both the friendly countries will come to support Sri Lanka. I mean, they have to necessarily, to the south of Indian subcontinent, Indian government doesn't want to have an economy with chaos. So therefore, it is just like you have a son who is doing all kinds of naughty things, but since it affects the family, you are trying to protect the son and also trying to bring him back to normalcy. It's like that. Similarly, China also has an interest in Sri Lanka, and both countries will have to provide investments in Sri Lanka, so that, as I have mentioned earlier, we would be able to curtail the domestic consumption, and we can increase our exports to the rest of the world with Chinese support. Now, I can give you a good example. Thailand did this about, say, 10 years ago. Thailand has these special economic zones located throughout the country, and they are all managed by the Chinese management firms, just like our Hambantota Harbour. I have visited some of these places. They are managed by the Chinese management firms, and in some of the economic zones, you find all the big companies like Samsung and the Japanese companies like Panasonic. They have set up their manufacturing facilities in Thailand. So that is how Thailand has been able to increase the high-tech product export components out of the manufactured products from nothing to about 40% within the last 10-year time period. In Sri Lanka's case, it's only 1% today. So that is where the two countries will have to support Sri Lanka, but we have to play the game very carefully and get the investment. But if we try to run the country like a family-owned private company, where the equity investment is not welcome, then you can't attain any of these targets that we are having challenge.
Deshal, like you had tried to point out, Sri Lanka possibly has two challenges: one of its external debt, and then secondly of its budget deficit locally. Right? How much of pressure can be eased? Is it significant pressure that can be eased if China and India step up with support so that we can manage our external debt payments in the next couple of years?
So it's like this. I mean, it's not a one-off game, right? So we have about $20 billion that mature on external liabilities in the next 5 years. Reserve levels right now are at around $5.5 billion. So typically, so without access to global capital markets to be able to roll over debt, we need something that steps in to fill that gap, right? So the swaps can certainly help in terms of easing the pressure to some extent. But I think the bigger part of the government's strategy is in terms of trying to attract foreign direct investment. I'm still talking about addressing the external debt component, right? So the expectation is that we can use FDI to replace the capital inflows that we got from from sovereign bonds and syndicated loans in the past. Now, this is again, it's an ambitious objective. Particularly because FDI takes time to materialize. There's quite a bit of a lag period normally between the start of a project to the to conclusion. So really, the most feasible way in which the government can raise external non-debt creating inflows quickly is by the divestment of existing state-owned assets, right? So be that land or shares of companies. That is the fastest way to achieve this strategy. That is, of course, politically quite challenging, but we all know that this government has the political capital to be able to pull that off if it plays its cards right. So I think that is really the bigger play than the swaps. The swaps will really just be a holding operation, right, to keep us solvent while we try to leverage this overall strategy. And it's like this. I mean, the whole idea of trying to shift from foreign debt to local debt is again it's not a new strategy that has been in play for a while. It was published in the medium-term debt strategy that was published, I think, in 2018, jointly between the central bank and the treasury. So the difference there is that it still has the same objectives of shifting from foreign debt to domestic debt, but it does that over a period of time. So what we're trying to do now is to effectively do that shift overnight. And that leaves us open to this rollover risk, right? So that is really where the difference in the strategy is. And so really, in order to avoid this rollover risk is really where the FDI component will play a major role. And that too, as I said, greenfield is going to be tough. It'll have to be through the form of divestments, which has its own political challenges.
There's a question as such, right? If Sri Lanka's international sovereign bonds are trading at a discount of up to 40%, in some maturities, is it not a good idea to buy these up? If the local commercial banks have some money, that shouldn't these be a great investment? I don't know how feasible this is. What are your thoughts about that?
Well, of course, some interest Sri Lankan commercial banks don't have that money. If you look at the latest monetary data of the Central Bank of Sri Lanka up to November 2020, we have a negative net foreign asset position held by the commercial banking sector to the extent of 831 billion Sri Lanka rupees. In other words, their liabilities are much more than the assets. So they don't have liquid cash to buy this. I mean, if we can buy it and if the Sri Lanka government doesn't default it, that's a very profitable investment. In fact, some of the banks did that. So how they did it was, again, it complicated the matter, because what they had done is they had borrowed from their correspondent banks, invested in the government ISBs, about say 1.6 billion US dollars they had invested. And when the correspondent bank started, imposing limits on their borrowing, because they also have to have a prudential limits on Sri Lankan bank, then our banks had a big problem. They couldn't borrow anymore, and they had to pay that short-term borrow. Because now, if you buy a 10-year bond today at 60 US dollars, and you borrow short-term from the correspondent bank, and you have to pay it back. So it became a huge liability, and central bank had to intervene and impose a restriction on the local commercial banks for buying these ISBs, except out of the foreign exchange that they have earned, not out of borrowing. I mean, it's good for anyone, but anybody, if you buy it at at this cheap price, and if you have a reasonable expectation that the government of Sri Lanka will not default them, it's a good investment. I mean, when the US treasury rates are less than 0.5%. Sometimes it is negative. When you get 15% from the 10-year ISB from Sri Lanka, it's a massive, revenue, massive earning for you. But of course, remember, high yield, high risk also. And it happened to people who had invested in the Greece bonds in 2013, 2014.
Okay, so thank you very much for this conversation. Some of the themes that are coming out of this are that Sri Lanka has two challenges. One, on the external side, it's got $20 billion of external liabilities that it needs to settle in the next 5 years. An ISB Sri Lanka has issued with the same time frame is selling at a 40% discount. So it potentially makes it impossible for Sri Lanka to go back to the markets unless those rates come back to realistic levels. At the same time, it's got a domestic challenge. It's got this challenge with economy that has stalled because of the pandemic and limited space. Gentlemen, I much appreciate your time on this call. I'll ask each of you to take a few minutes if you have any final thoughts. Can I start with you, Mr. Vijayawardena? Any final thoughts to wrap this discussion?
My final thought, because as I have told you, we are beggars and we are not choosers. And if you don't want to get money from outside, and if you have this patriotic, vision of, not selling out your country, you must be prepared to make the maximum sacrifice out of your own efforts here in Sri Lanka. That sacrifice should come from, in my view, not only from the lowest level people in the society, but also from the top, from president onwards. You may recall in 1972, when Sri Lanka faced with such an economic catastrophe, Mrs. Bandaranaike came on Sri Lanka Broadcasting Corporation, and she said, we are sitting on a volcano, and the volcano might explode at any point of time. If it explodes, we are all dead. So therefore, she introduced the type of, the hard, economic policies during that period. Similarly, I expect the President Gotabaya Rajapaksa to come out and tell us, we are not in a very comfortable situation. We are all as a nation facing this particular problem. Problem has been aggravated by the COVID-19 pandemic. We cannot have the same luxury and same comfort which we had in the past. So let us make this sacrifice. Let us work harder. Let us work more and do, what we have to do for the nation. So that should come from the president. He has to make this announcement.
To be clear, Dr. P.V. Jayasundara several months ago when the pandemic hit suggested that state workers forego 1 month's salary, and he suggested the saving would be 50 billion rupees.
It's a very good suggestion, Samendra, even though he was criticized by some people. We cannot, do it with 1 month today. As I have suggested, it will be 6 months, like, during the times of Sinhala kings.
So yeah, foregoing some salaries for
state workers. Forego. All of us will have to forego. I mean, the life is more important than, it is like, dying or whether having, half consumption. That's the choice we are making. And every choice has a cost as well as its own merits.
Deshal, any final thoughts?
Yeah. So the promise of MMT is that 4 conditions can hold, which are completely alien to the usual to traditional economic theory, right? So these 4 conditions are: you can simultaneously have economic growth, stable currency and stable prices, low interest rates, and a high budget deficit. Now, these 4 can really only hold if you have government spending that results in supply capacity increasing at a faster rate than aggregate demand, and thereby not putting pressure on creating excess demand and not creating imbalances. And it can also only hold if imports can be controlled without hurting growth. Now, in Sri Lanka, we know that both of these are going to be quite tricky. So we know that it will be controlling imports without hurting growth is very difficult, because 80% of imports are involved in the production process. So to achieve all 4 of these in Sri Lanka is I think really untenable. So the answer to it, or the kind of the solution or the exit strategy, is really either interest rates will have to go up at some point, or the budget deficit will have to be reduced. So I think that is really where, and we need a path in which we can do that without being overly disruptive to the nascent economic recovery that we're seeing right now.
In your closing thoughts, you're also suggesting that Sri Lanka's leadership should step up and tell its citizens that Sri Lanka faces hard choices, and also Deshal, you're talking about clarity in our exit strategy. We cannot be muddled in nothing sort of statements that we make, and be making contrary statements. There has to be clarity about how we will exit out of this excess liquidity situation or the printed money that we have in the economy. Gentlemen, I greatly appreciate, on behalf of everybody who joined us online on the Zoom call and also on Facebook, thank you very much for your time. It's been an enlightening conversation. This conversation will be continue to be available on Facebook and also YouTube, and also in the next issues of Echelon. So I greatly appreciate your time, and on behalf of everybody who joined, thank you very much and have a pleasant evening.
Thank you very much, Shamindra.